They talked about some of the stuff that the macroeconomists have already pointed out. We needed more stimulus. Now, could you have gotten that out of government? That's a debate, right? The other issue is they said we should have helped the average American more. Whether that would have actually done anything to improve it, but it certainly would have put a better gloss on the entire thing. Because let's face it, right now the average American still believes that this was saving Wall Street, not saving the financial, the capital markets.
Which, of course, begs the question, and we discussed this just a few moments ago, when you hear comments like Jamie Dimon saying he could beat President Trump, not exactly putting his hat in the ring, but not exactly not in terms of maybe a future election run. Would that actually go over well with Main Street?
That Jamie Dimon?
That it would go over well with Main Street, given the fact that 10 years ago the optics were that Wall Street got a bailout.
I think the way to think about this is doctors versus bankers.
Okay.
If a banker gets rich, is he popular? No. If a doctor gets rich, is he popular? Yes. He's doing God's work. So when a famous CEO said, "We're doing God's work," the Goldman,
yes.
I winced at that because the business itself is necessary for the economy. There's great macroeconomic work that supports that, but it certainly isn't popular, right? When bankers' compensation was one of the mistakes in the crisis, the street overpaid itself.
And even Paulson today said he couldn't believe how much it showed banks' lack of awareness of what was going on at the time. Bernanke was asked specifically about Lehman. Take a listen to that.
Making a loan against the collateral that was available would at best sustain the company for a few days, that it was not a viable business, that all we would do is end up bringing a lot of bad assets under the Fed's balance sheet and maybe protect a few creditors, but it would not be sufficient to keep the company alive. And that was the critical element. And so, again, not a narrow legal judgment, it was a judgment about feasibility, and that is something on which we have never wavered.
This remains a pretty potent debate even today. There are those who believe that if you had done more to save it, you might have undone a lot of the damage that came afterwards.
I was in Milan. I landed in Milan on Monday morning when Lehman filed for bankruptcy. While I was in the plane, it was clear that Lehman was filing for bankruptcy and that this trip was a mistake. We set up Bernstein set up a conference call with 1,100 institutional investors. Now remember, Wall Street's analysts were muffled at this point because all of their firms were involved in the crisis. They couldn't talk. So the beauty of being the Bernstein analyst at that time was right.
Yes.
I was the only one who could talk. The question from the 1,100 major institutional investors was, why did Lehman fail? The Fed stepped in to save Bear. The Fed provided Lehman's broker-dealer access to financing. So the surprise of that caused everyone to panic. So, I guess the debate will always be, should you have done an AIG for Lehman? Because that would have delayed the crisis, spread the crisis more. It certainly caused institutional investors and banks around the world to pull in, right? They pulled in all of their exposure and in the process cut lending, cut foreign exchange lines, and the world teetered at the edge. The Fed pulled it back. And we need to take our hats off to those guys. But that was a mistake. Letting Lehman go down was a mistake.
10 years later, I mean, you're a professor. You're teaching, I'm sure, quite a number of millennials. It's now the biggest generation in America. It's an adult generation that has basically come of age after all of this happened, has existed in an environment with very low volatility in terms of financial markets, outsized, unprecedented stimulus from the central banks, low interest rates, et cetera, et cetera. How do you teach this generation about what markets looked like before the crisis? And is this the new normal 10 years out?
Actually, there's great data, just wonderful, wonderful data. It's used by very many people. The Securities and Financial Markets Association has a database that goes back quarterly all the way to 1980. You can actually see in numbers how the Wall Street built its trading business, leveraged itself up, and then blew itself up. It's it's a beautiful story in terms of teaching people, not in terms of
in a morbid way.
But in any case, the other one is to teach them the reality, which is quantitative analysis doesn't always work. I mean, I was 100% wrong in August of 2007 when the crisis went global. At that point, you had BNP Paribas say they're not going to be able to mark to market. And I wrote the worst piece of research I had ever done. And the piece showed all the previous downturns in the financial market, credit events. And I said, the average is 2.2 quarters. The average is about a 40% drop in fixed income revenues. The Street can handle this. Right. It was wonderfully quantitative and 100% wrong.